This is level 1 of the CFA program, the topic on corporate issuers, and the reading on cost of capital. This is the reading that links our two previous readings. Remember, we had a reading on the sources of capital. We called that working capital management and capital budgeting. And then we had a reading on the uses of capital, and that's where we had our discussion on net present value and executives investing in wealth increasing projects. Well, this is the reading that links those two by way of an interest rate. Let me give you a quick example that I tell my students all the time. I say to my students, do you remember the day that your parents or your grandparents or whoever it was in your family or your loved ones who dropped you off at college, and they said something like, you know what, have a great time, but you better, and remember they wagged their fingers at you, and maybe they didn't do it literally, but they said things like, you better study hard, you better get good grades, you better go to class all the time, you better surround yourself with high quality friends, maybe get an internship and get a job after you graduate, right? Wagging your finger, hey, this is the key to success. Well, this is what capital structure is. On the right-hand side of the balance sheet, we've got short-term, we've got bondholders, and we have shareholders, and they provide the capital. And so they say to the executives, they say, sure, here's all of our money, right? Sometimes it's hundreds of millions of dollars, even tens of billions of dollars. And so the investors on the right-hand side of the balance sheet say, okay, we believe in this positive net present value project that you need our money for. So here's our money, take it, but, and here's the wagging of the finger, you better earn 10%. Let me just make that number up. 10% cost of capital. And if you don't, then we're going to pout and we're going to go to the floor of the bond exchange and the floor of the stock exchange and sell our bonds and sell our shares of stock. And that'll make life miserable for you. And that's really what the cost of capital is. It's an interest rate that links the right and left-hand sides of the balance sheet. Now, as we look through these learning outcome statements, notice that some of the action words tell us that we're going to have to calculate. Now, the good news is that the calculations are super simple, and I'll take you through those. We're going to look at some different kinds of approaches to determining that weighted average cost of capital. And then we'll talk about beta and the capital asset pricing model. And we'll end with a short discussion on floatation costs. So let's go ahead and jump right to it. Calculate and interpret the weighted average cost of capital. So before we do anything, I want you to look at that formula inside of the gray box down at the bottom of the slide. So we've got weighted average cost of capital on the left-hand side of the equal sign. And notice that in between the plus signs, there are a handful of W's. These stand for the weights, the proportion of total capital on the right-hand side of the balance sheet. And those are, of course, the weight in the three main sources of long-term capital: the bonds, the preferred stock, and the common stock. And then, of course, notice that there are a handful of lowercase r's inside and in between those plus signs, and those are the required returns on each source: debt, preferred, and common stock. Now, of course, the reading, because we're on the right-hand side of the balance sheet, the reading refers to these as costs. So the RD is the cost of debt, the RP is the cost of preferred stock, and the RE is the cost of common stock. Now, don't get confused. Don't think of cost in terms of dollars. Think cost in terms of an interest rate. And notice there's a 1 minus T in bolded red. We need to make certain that we adjust this for the tax policy of governments out there. And in most cases, governments allow executives to subtract an interest expense on the income statement. So we need to convert that before tax RD into an after tax RD. Notice there is no tax over on the right-hand side after that first plus sign. On the income statement, there's no such thing as preferred dividend expense. There's no such thing as common dividend expense. So we don't need to worry about the tax implications over there on the far right of that equation. So let's skip back up to the top embedded circle points. Let me read this to you. In the absence of a suitable discount rate, NPV and IRR have no meaning. So this is what I was talking about, the link between the right-hand side of the balance sheet and the left-hand side of the balance sheet. And what we're going to do is we're going to use this weighted average cost of capital to compute the net present value, and we're going to use it as part of our decision rule in determining whether or not a project is acceptable according to the IRR method. Remember that NPV and IRR are two ways to evaluate a capital budgeting project. What we need is an interest rate in order to compute the net present value, so we're going to use the weighted average cost of capital. Now recall, in that reading on the uses of capital, we used the term required return on assets, and that's exactly what it is, but now we're going to substitute the term weighted average cost of capital. Think of it as the bondholders and the shareholders wagging their fingers at the executives. Now that last slide gave us a sense of how to interpret the weighted average cost of capital. Let's go ahead and do the first part of this LOS, calculate with a quick example. So let's suppose that we have a company with $300 million in common equity issued, with $100 million in preferred equity issued, and $200 million in debt issued. So if you take the 3 and the 1 and the 2, you sum, that must mean that the executives have invested $600 million in positive net present value projects. Now look at the second arrow point under each embedded circle point. So 20% expected return on the common, 12% expected return from preferred, and a 10% yield on the bonds with a 30% corporate tax rate. Now, notice that we have a 20% and a 12% expected return from analysts. So this is our job to come up with that 20 and 12 and that 10%. And of course, later on in this slide deck, we'll show you exactly how to compute those individual expected returns. So the question then becomes, what is the weighted average cost of capital? So we have 3 sources, right? When the executives need capital, they go to the bondholders, they go to the preferred shareholders, and they go to the common shareholders. What is the weighted average cost of capital? How about if I couch it in maybe more general terms? What is the weighted average interest rate? There's a good way to think about this weighted average cost of capital. So let's do the weights first. There's the equation down at the bottom. Let's do the WD, the WP, and the WE. And that's 3 out of 6, and 1 out of 6, and 2 out of 6. So 50, 16.7, and 33.3%. Those are the capital structure weights. The individual component costs of those sources of capital is given to us. Let me just go back here and remind you from the analysts, right? 20, 12, and 10. And there's our application of the formula at the bottom. So let's make sure that we don't forget to take 1 minus the tax rate. That's why we put that in bolded red. Don't forget that, because of course, on a multiple choice exam, answer A is going to be without the 1 minus the tax rate. Answer B will be with the 1 minus the tax rate. So make sure that you do all the math correctly, you do the inputs correctly, and you get 14.34% as the weighted average cost of capital. So when I ask this question on exams, I always give the question in pairs. I'll ask the students to calculate the weighted average cost of capital, and then I'll follow up with, hey, what does that really mean? So think about it this way. This is really just, just an intermediate step. We're going to take that 14.34% and we're going to use it as the discount rate to compute the net present value of our product line. Now here's a good LOS that we've already answered, right? Describe how taxes affect cost of capital from different capital sources. All right, in most jurisdictions, I said this earlier, interest payments are tax deductible, which means there is an interest expense on the income statement. So all we need to do is multiply our before tax cost of debt. The reading refers to it as the gross cost of debt. Multiply that by 1 minus the tax rate. And of course, the tax rate ought to be given to you in the problem. And that gets us something that we call the after-tax cost of debt. The reading refers to it as the net cost of debt. Equity, what did I say just a moment ago? There's no such thing as a dividend expense. So let's go ahead and forget about tax effect on preferred and common stock. But let's remember now that because the interest payments are tax deductible, that means that executives view bond issues as having a tax advantage. Let's go ahead and figure out how to compute some of those component costs. So we're focusing here on the top portion of the right-hand side of the balance sheet with the bond issue. So let's go ahead and use the yield to maturity approach and the debt rating approach. So this is a super easy question, yield to maturity. We'll do this in another reading when we solve for bond pricing and bond yields. So let's suppose that we have a 20-year bond with $100,000 face value, $106,000 of market value, 10% coupon rate. Coupons are semi-annual, marginal tax rate of 40%. So let's go ahead and compute the before-tax cost of debt and the after-tax cost of debt. And so on the next slide, go ahead and get out your financial calculators, and there are the inputs, present value, future value, payment. Make sure you divide that 10% by 2 to get a $5,000 payment, and then multiply the 20-year bond by 2, which gives us 40 periods. So if you do all that, you get 4.67%. Multiply that by 2, you get 9.34%. Multiply that by 1 minus the tax rate, and you get 5.6%. So let me go ahead and show you how to enter these in your calculator. All right, I want you to get in the habit of doing this. See your second function here, and there's a clear time value of money. So do a second clear time value of money. That wipes out anything that you have entered in the past. So here, let me just put a big old long oval around the 5 time value of money buttons. Here we're going to enter 4 inputs and then solve for the 5th. Of course, that I/Y button is the yield to maturity button. All right, so you ready for this? Now, let me just warn you that when you enter present value, you're going to have to make it negative. I want you guys to remember this. Are you ready? Write this in your notes. When solving for the yield to maturity on the bond, comma, make present value negative. So there's our present value minus 106. Then we'll do 100 for future value. And then we'll do 5,000 for payment. 40 is N. And then remember, those of you who have the Texas Instruments, you might be tempted just to hit that button, but you need to hit the compute I/Y, and there you go, 4.67. Now, those of you who have my favorite calculator, the HP, your 5 time value of money buttons are right up here. Don't forget the change sign button to solve for the yield to maturity on the bond. All right, before tax costs $934, after tax costs 5.6. So that's using the yield to maturity approach. So you might want to make a note to yourself, and I said this earlier, you really just want to use your 5 time value of money buttons on the calculator. So let's go ahead and move to the debt rating approach. You guys will really like this one because this is super easy. We're going to use this when reliable current market price data is not available for that company's debt. So this is all we do. We say something like, well, let's go find another company that looks an awful lot like this company. And that company has publicly available information and its debt is publicly traded. And let's go ahead and just use that particular benchmark. Of course, now remember, this is the debt rating approach. So if we believe that the bond in question is rated, let's say, single B, then we'll go out and find a benchmark in which we look at a single B rated bond. So here's just a super quick example. Suppose that comparable yield to maturity is 6.25%, 30% corporate tax rate, and so we do the math pretty quickly there at the bottom. So debt rating approach is really just a comparable approach. We don't really have any data on our specific firm. Let's go out and find somebody else who looks exactly, or how about if I say exceedingly similar to us. Moving on to the middle of the right-hand side of the balance sheet with preferred stock. And so we need to make sure that it's non-callable and non-convertible. So there are no embedded options in this preferred stock, which means that that preferred stock looks an awful lot like the preferred stock that you learned about back in your undergraduate days when you had financial accounting, that introductory financial accounting. So a little background here, the price of a share of preferred stock goes over an infinite timeline because you can hold on to those preferred shares until you pass away and you leave those shares to your children and grandchildren. And that's because the firm operates as a going concern. And so the price of a share of non-callable, non-convertible preferred stock is just the present value of those dividends. And remember, most preferred shares offer a fixed dividend. They don't have to, but most of them do. And so the price of a share of non-callable, non-convertible preferred stock is given right there. So P sub P, the current price of preferred stock, is really just the present value of an infinite dividend stream. Those of you who remember this terminology from our time value of money discussions, this is really just the present value of a perpetuity, where you take that perpetual annuity, right, that fixed dividend payment that goes on forever, and you divide it by the required return on preferred stock. The reading refers to it as the cost of preferred stock. So in order to calculate and interpret the cost of preferred stock, we need to do the cross multiplication. So just switch the R sub P with the P sub P, and that gets us to the cost of preferred stock down there at the bottom. So here's just a super quick example. Let's suppose we have dividends of 724. Those are probably annual dividends, and those are probably fixed. Stock price of 102, marginal tax rate of 35%. Just scratch that right off. You know, we can ignore that in determining the cost of preferred stock. So here we're just going to take the dividend divided by 102. So we get the 710 as our cost of preferred stock. So where are we in our life? We've shown you two ways to compute the yield to maturity on the bond, which is the cost of debt. And we've shown you this simple way. Boy, it'd be nice if you had 25 questions like this on the exam, because you'd get all 25 of them correct, because this is super simple. Which means we have to go down to the bottom right-hand portion of the balance sheet. And how are we going to determine what that cost of common stock is, the cost of equity capital? Now notice there are two approaches. We're going to use the capital asset pricing model approach here on this slide, and then we're going to use the bond yield plus a risk premium approach. So we're going to use a little bit of information that we learned back in the bond pricing section, and that we're going to apply it to the stock pricing section here. So let me give you a little background about this capital asset pricing model. It was developed in 1964 by a dude named William Sharpe, among a handful of others. William Sharpe won the Nobel Prize in economics in the 1990s for this work. And what William Sharpe did was build on the work of Harry Markowitz, who developed the efficient frontier and brought into the lexicon the idea that standard deviation is a great measure of risk. Well, William Sharpe was among the first to note that you can divide that standard deviation into two components. One of those components is known as systematic risk. Let me give you a definition of systematic risk. It's the variability in stock returns due to changes in economic factors, like inflation and the price of oil. The other component is known as unsystematic risk. And that unsystematic risk can be defined as the variability in stock returns due to changes in firm-specific factors, things like net present value, things like executive leadership, things like free cash flows. So what William Sharpe did in 1964 is say something like the following. He said, all right, what is a reasonable estimate of the required return on equity, or in this terminology here in this reading, the cost of common equity? And he said, well, let's go ahead and start with the risk-free rate of interest. So there we have the RF to the right of the equal sign. William Sharpe said, surely the return on a company like Johnson & Johnson has to begin with the risk-free rate of interest. But there has to be a plus sign, right? You would never invest in Johnson & Johnson because it has positive risk. If you could get the same return by investing in, let's say, a treasury security, right? So there's the risk-free rate of interest plus something. And here's the genius of the William Sharpe thinking. William Sharpe said something like, all right, I know that investors hold well-diversified portfolios. In fact, according to Harry Markowitz and then the capital market line, every investor out there is going to hold the market portfolio. So I want you to think about it this way. William Sharpe said, all right, the return on a company like Johnson & Johnson has to be a function of the risk-free return plus everything that's going on the floor of the New York Stock Exchange. And if we take a global or a bird's eye view of the floor of the New York Stock Exchange, we could say something like, hey, there's a well-diversified portfolio. What if I owned one share of every one of those stocks that's trading on the floor of the New York Stock Exchange? I would own something like the market portfolio, and my return would be the expected return on the market portfolio. Now, of course, William Sharpe defined that market portfolio as including shares of all different kinds of assets, not just limited to the New York Stock Exchange, but I think it's an okay visualization. So William Sharpe said, all right, we start with a risk-free rate of interest. We see what's going on inside of the New York Stock Exchange, and then we subtract out that risk-free rate of interest. So I want you to look in those brackets there. The expected return on the market portfolio minus the risk-free rate. We call that a market risk premium. It's the premium for taking market risk. Now, this is a line, right? Just like we learned back in first grade or fifth grade, y equals a plus bx. And so we have the rise over the run. So what we need to do is we need to weight that market risk premium by some slope. And that slope is going to be the beta of that individual stock. And beta is a measure of systematic risk, right? So what do we have as a definition there? The equity beta, or the return sensitivity to stock I to changes in the market return. And that's the beauty of the capital asset pricing model. It's super simple and it's easy to apply. And the good news is that lots and lots of professionals, not just those who hold the CFA designation, but professionals who earned and hold other types of designations, use this capital asset pricing model. So there's a good interpretation of the cost of equity. William Sharp says, look, the cost of a company equity such as Johnson & Johnson depends on treasury markets, New York Stock Exchange returns, and the level of systematic risk. Now, this reading just tells you to think about it as return sensitivity, and that's perfectly fine. We'll spend lots more time on the capital asset pricing model in a future slide deck. So let's go ahead and take a look at an example, and this is how easy it is, right? Equity beta is estimated to be 1.2. Now here, let me give you a little preview. The beta of a market portfolio is 1, so our equity beta has 20% more systematic risk than the market portfolio. How about if we have a risk-free rate of 4 and a market return of 8? So think about it this way. If we have 20% more systematic risk than the market portfolio, then we need to have a higher cost of common stock, and it turns out to be 8.8%. There we go. We interpreted that cost of equity capital. Now we just calculated it using the capital asset pricing model. Let's move on to the bond yield plus risk premium approach. And I think you'll like this one because it reflects a couple of thoughts that we had just a few slides ago. All we're going to do is begin with our bond yield, and we're going to add a risk premium. Now, it's interesting that in the reading, during this discussion, the authors use the term, suppose there's an arbitrary risk premium of, I forget what the actual percentage is. So the authors don't give us any idea about how to compute this risk premium. Now, of course, I could spend another 30 minutes telling you and giving you some ideas on how to compute that. But my point is that in order to calculate the cost of equity capital using the bond yield plus a risk premium approach, according to the reading, the Institute has to just give you this risk premium. And so look at that equation. So we're solving for R sub E, which is the cost of equity. Remember, in a previous chapter, we may have referred to it as the required return on equity. And all we're going to do is start with the before-tax cost of debt. There's that R sub D. Plus, and dare I use that terminology, an arbitrary risk premium, which ought to be given to you in the question stem. So that risk premium is really just extra compensation that shareholders require for assuming the additional risk of equity as compared to owning the bond. So let's do a quick example here. Look at the bottom of the gray box. Suppose that we have a company that has just one bond outstanding, and there are some characteristics. The price of the bond is 98, coupon rate is 4.2%, and is 10 years. And we'll just go ahead and make the general assumption that this bond pays interest twice a year. Now notice that next line. Analysts believe this firm equity carries a 5.9% risk premium. So there it is, thrown right at you in the question stem. So let's go ahead and remind ourselves of the steps used to compute yield to maturity, which we did earlier, and then let's go ahead and add the risk premium. So go ahead and get out your calculators. You probably don't need me to show you this once again. Make present value 98, make that negative. Future value, we're just doing $100 of par value, right? N is 20, it's a 10-year bond. Multiply 10 by 20. Coupon rate is 4.2, so that's $42. So divide that by 2, and you get $21 per 1,000, but that's $2.10 per $100. Solve for I, you get, what is that, 2.2 something. Multiply that by 2, and then add the 5.9 risk premium, and that gets us 10.35%. So let's go ahead and make sure we can get the interpret part of this LOS accurate. What are we doing? That 10.35%, it is composed of two parts. It has the bond part, which reflects things like, remember that yield to maturity is going to reflect things like default risk. Maybe it reflects things like interest rate risk. Maybe it reflects things like liquidity risk. But it reflects the riskiness associated with the bond issue. And then we're going to add the riskiness associated with equity. So think about this bond yield plus risk premium approach as really a capital structure approach. We're going to take something from the bondholders and add something from the shareholders to get that total cost of equity. Now, swinging back to our capital asset pricing model, let me go ahead and do this here. Let's go back to this equation. So notice we're solving for the cost of equity. And by the way, that E and parentheses R sub I, that's the William Sharpe notation. And so you almost always see cap M shown in this form, but it still stands for the cost of equity on the left-hand side of the balance sheet. So notice that beta sub I there. That's the equity beta. It's a measure of return sensitivity. Well, the question becomes, how do we get it? How do we come up with that beta? It's a measure of systematic risk, right? It's a measure of sensitivity. A couple of different ways that we can do this. Oh, dare I go back to our quantitative analysis? We can estimate that using regression analysis, or we could just use its formula, covariance over variance. But we run into some problems, and that's what this LOS. Are you ready for me to read this to you? Explain and demonstrate beta estimation for public companies, thinly traded public companies, and then non-public companies. All right, so we have a beta. If we have a public company, this is super easy. We can just go out and collect returns on the company stock. And this is really easy to do in Yahoo Finance. You can just download into an Excel spreadsheet daily or monthly or weekly or annual stock returns for a company like Johnson & Johnson. And then you can download returns on something like the S&P 500 index. And you can use the Excel regression technique, or you can just use covariance over variance. And so beta estimation for public companies is readily available. It's readily observable. In fact, if you go to Yahoo Finance, Yahoo will just give you their estimate of the beta. Now, they don't really tell you exactly how they get it, but they got it from one of those two ways. Yeah, so look at the requirements. Ready? So the index to use in the regression. So what did I say? S&P 500. You can use the NYSE composite, or you can use, pretty much any other index that's relevant to what you're trying to do. And you have to choose the length of time. So 5 years of monthly data is most common. Now, remember back in our quantitative methods analysis, we introduced this concept of reversion to the mean. And this is what we observe in the betas for publicly traded corporations, that companies that have super high betas, like 1.7 or 1.8 or 1.9, they tend to drift downward to the mean of 1.0. Those companies that have low betas, like 0.3 or 0.4, they tend to drift upwards. So what we need to do is demonstrate beta estimates for companies that show what's known as a beta drift, right? Drifting upwards towards 1 or drifting downwards towards 1. So there was a researcher named Bloom who sought to adjust the beta, and there's the equation for the adjusted beta. Well, what he decided was we're going to weight the regressed beta that we did up at the top of this slide deck with the average of 1. And instead of having an equal weighting, he decided that 2/3 of the regression beta and 1/3 of the mean reversion was appropriate. So you won't have to compute this. You'll have to demonstrate. Sometimes demonstration does mean compute, but make sure you can just do that weighted average. So the adjusted beta is weighted average. Just remember 2/3 and 1/3. How about thinly traded and non-public companies? All right, so what we're going to do is use this thing called a pure play method to estimate the beta when that company is not publicly traded. So what did we do earlier? We found a company that was, I said identical, but then I changed that to exceedingly similar. So look at the second teardrop point, a comparable publicly listed company's beta. So we're going to find a company that looks an awful lot like the company in question and then adjust it, doing and completing the following steps. So there they are in the bottom. So we're going to explain and demonstrate these. So first of all, identify a publicly traded benchmark company. Now, how do we do that? Well, you can do it by size, assets, size of the bond issue, size of the equity issue. Or you could go over to the income statement, size of revenues or size of net income, or you can do any kind of ratios in there to identify a publicly traded benchmark company. Once you find that company, then you go ahead and estimate the beta. So go back here right to the top, regressing the returns of the company stock to the returns of maybe the S&P 500 index. So that's pretty much the easy part. Then what we need to do is we need to reach into that beta. Are you ready for this? We're going to reach into that beta and extract out the leverage component of it. And then we're going to take our leverage from our company and put it on top of that beta. So that's all we're doing. We're going to unlever and then re-lever the beta. So think about it as deleveraging and then re-leveraging. I don't know if those are words, but I think they make sense. So there we go. Unlever the benchmark's beta by, so we're solving for B sub U. So that's the unlevered beta. The reading also refers to it as the beta from the assets on the left-hand side of the balance sheet. And so there's our equation. All we're going to do is take that equity beta that we regressed, right? And then we're going to adjust it by some kind of a proportion. So 1 over 1 plus the debt equity ratio. So we take out the leverage of that regressed beta. And then we substitute the capital structure of the thinly traded or the non-public company in there. So 1 plus the debt equity. So we delever and then we relever. Sounds like a Seinfeld episode. Of course, the world doesn't exist in a vacuum, and whenever a company goes to the right-hand side of its balance sheet and issues bonds and issues shares of stock, it does it, of course, you guys know all this, with the help of an investment banking firm. And the investment banking firm is perfectly willing to help companies raise capital, but of course, they're not going to do it for free. So we need to consider these floatation costs. Now, debt and preferred stock, the reading tells us that those floatation costs are negligible. So the implication is that they can be ignored. For equity capital, this is not true. They can be super material, and they should be included when estimating the cost of equity. And so what we're going to do is we're going to use and incorporate floatation costs according to what's known as the Myron-Gordon growth model. And that Myron-Gordon growth model is a model in which we estimate the price of a share of stock according to a constantly growing dividend. And what we do in this approach here is we rearrange this Myron-Gordon growth model to solve for the required return or the cost of equity. So notice to the left-hand side of the equal sign, there's the R sub E. And what we're going to do is we're simply going to take the ratio of the dividend, and that's the D1, that's the dividend in time period 1, and we're going to divide that by the price of a share of stock, but we're going to subtract out the floatation costs if they're given to us in terms of dollars. So think about it this way. We take the dividend, let's suppose that's $1, and we take the stock price, let's suppose that's 105, and the flotation costs are $5. So we take the $1 divided by the 100, and we get 1% plus that growth rate over there, and that's going to be our demonstrate the correct treatment of flotation costs if given in a dollar amount. However, sometimes those floatation costs can be given to us as a percentage, and that's what we've done in the second gray box. We're going to take that price in time period 0 minus 1 minus, or I'm sorry, times 1 minus the flotation costs as a percentage. So think about it this way. If we issue shares of stock and we're issuing them in terms of and receiving $105, we have to pay the investment banking firm out of that $105. So we can do it either as $5 as a dollar amount or as a percent, and that's going to give us our flotation cost estimate of the cost of equity. Now, there is a second approach here. What we can do is we can adjust our cash flows in the valuation component. In other words, when we're computing the net present value, in other words, when we are computing the operating cash flows, we can just consider those flotation costs as an additional cost of the project. And so notice the second embedded circle point. It is the recommended approach. And that takes us through these learning objectives. Remember, that first one is the super important one. Calculate and interpret the weighted average cost of capital. And all of those other LOSs flow from that particular first one.